Hi, everyone. My name is Andrea Seminelli, Business Development Manager for Adam Global. It is a pleasure to welcome you to today's webinar on transfer pricing. With over 22 years of industry experience, with a network of over 200 global advisors, and a team of experienced chartered accountants, we at Adam Global are dedicated to empowering your business, from VAT and corporate tax support to internal and external audits, bookkeeping, and business planning. We provide comprehensive business solutions. Join us now as Mr. Abbas, partner at Adam Global, as well as Canadian CPA, with over 2 decades of experience in audit and finance, as he explores the complexities of transfer pricing.
Thank you very much, Andrea, and thank you everyone for joining us today. Today's topic, why transfer pricing is important. We're going to go through it today in detail as much as you can. It's a very detailed, in-depth topic, but we will try to cover as much as possible, and then we would like to have furthermore webinars on the same topic, and we will try to take it from there. Okay, so first thing first, an introduction to transfer pricing, right? What is transfer pricing? Let's try to understand that first. So as we all know, the corporate tax has been implemented in the UAE from 2023, and as one of the main goals of the entities is profit maximization, obviously. They try to reduce their tax liability by to achieve that goal. What they do is they use transfer pricing as a tool, right? So we, as an accountant, we need to know what are the repercussions or implications from taxation point of view and from compliance point of view. What are the things that we need to be aware of? Okay. So due to the globalization and cross-border trade, transfer pricing has become pivotal. It's of pivotal importance to all the stakeholders. If it's the accountants, if it's the shareholders, if it's the government, if it's the tax authority, all the stakeholders are very, very keen, and they want to know more about transfer pricing. So we, as a stakeholder, we need to know what it is and how to take care of it, right? Now, from the tax authorities' standpoint, the goal of tax authorities is to prevent groups from price manipulation, right? That's what the groups would try to do, and therefore the tax authorities may assess the intergroup transaction prices to ensure those are at par with the market prices. That's very important because they will make sure we are not manipulating the prices, because that would lead to adverse tax implications. And you know what, if the tax authority, if they deem necessary, they might adjust the transfer price as well. They have the right to do so. Moving to arm's length principle and related parties. This is very, very important. These are kind of main pillars of this topic of transfer pricing. So let's understand what is arm's length principle and what are related parties. How do we define them? How do the tax authorities define them? And what are its implications on transfer pricing? Okay. So the arm's length principle, as introduced in the UAE under Article 34 of the corporate tax law, requires that transactions and arrangements between related parties or connected persons are priced as if the transactions or arrangements had occurred between independent parties under similar circumstances. That's the main goal. They want to see it as if those transactions were undertaken as a regular transaction. There was no relation between the two entities. That's the goal, right? The arm's length principle treats related parties and connected persons, such as, for example, members of a group, as if they were operating as separate entities rather than as inseparable parts of a single unified business, right? Since the separate entity approach treats these members as if they were independent parties, attention is focused on the nature of the control transaction. Okay? And on whether the conditions differ from the conditions that would have observed in comparable uncontrolled transactions. Now, this comparison is also called controlled transaction comparison, right? This is a very important term. So what they would do, based on the premise of this comparison, they would try to compare the prices that you have used and the prices that could have been used between the two independent parties, okay? Under the corporate tax law, the arm's length principle needs to be applied with respect to domestic as well as cross-border control transactions. So it may or may not involve cross-border transactions. It could pertain to two entities which are, in different countries, or it could be two entities within the same country. So let's go through an instance to grasp better understanding of the matter, right? Let's go through an example. Okay, so we have this example here. Let's go through it. So there's a transaction between related parties. We have a group called AB Group, okay, and it's comprised of two companies, Company A and Company B. Company A is located in UAE, while Company B is located in country Y, where the corporate tax rate is 5%, let's assume. Now, Company B purchased raw material at 15,000 per ton from Company A, while the market price of that subject material is 20,000. So as we can clearly see, they've underpriced, right? And instead of using the market price of 20,000, they have used 15,000. Let's see the implications of this on our group taxation. Company A has not made any profits from this sale, but had the transaction been done at the market price, it would have made a profit of 5,000, right? Now, Company B, next step, Company B sells the subject product to a third party at 30,000 and have made a profit of 15,000 by following the internal transfer price. Now, this profit could have been 10,000 instead of 15,000, right? Now, if we look at the total group profits, it stays the same. So the profits are the same in both the cases, but in terms of tax implications, there are differences, which we're going to see from the following table. So we were going through this instance. So on the left-hand side of the table, we have sale below market value, okay? And on the right-hand side, we have the sale at market price, which should have been the case, okay? So if we look at the profits in terms of market value sale, which is below market, Company A has made no profits while Company B has made 15,000 profits, okay? Now the tax rate for Company B is 5%. Therefore, if we look at the aggregate total group tax that we have paid is 750. Now let's look at the other side, right? Had it been at the market price, what would be the situation, okay? So Company A would make 5,000 profit, Company B would make 10,000 profit, and if we tax it at the same rates, Company A would be paying 450 and Company B would be paying 500, and therefore in total the group would be paying 950. Now you see the difference is clear, very clear. Due to this manipulation, the group is basically underpaying their tax liability. So the actual liability, which should have been 950, they are only paying 750. So that's how it works. And the goal of the companies, the entities, the groups have to be to, be compliant with the tax regulations. Compliance is the foremost thing instead of saving a few, dirhams here and there. So that's the main goal. That's what we are trying to understand here. Related parties. Now, this is another very important subject, and let's understand what related parties are, okay? So transfer pricing rules apply to related parties, which are defined under Article 35 of the Corporate Tax Law as any associated persons according to a specified degree of association. This association means pre-existing relationships with another person through kinship, in case of natural persons, obviously, and ownership or control regardless of whether that other person is resident or not in the UAE. Okay. So kinship or affiliation. The definition of kinship or affiliation overseas covers the relationship of two or more individuals who are related to the fourth degree of kinship or affiliation, including the way of adoption of guardianship. So as we're going to see on the next slide, is we have been given 4 categories of kinship or affiliation, and this is how the tax authorities would determine the related parties. Okay, so let's go through these 4 categories, please, one by one. So the first degree of kinship and affiliation, a natural person's parents and children, as well as the parents and children of their spouse. Okay, so that's the first category, which is very limited. And then the second degree of kinship and affiliation additionally includes a natural person's grandparents, grandchildren, and siblings, as well as the grandparents, grandchildren, and siblings of their spouse. So as we can see, with each additional category, the horizons are broadening and they are adding more and more relationships in there. So the third degree of kinship and affiliations additionally includes a natural person's great grandparents, great grandchildren, uncles, aunts, nieces, and nephews, as well as the great grandparents and great grandchildren, uncles, aunts, nieces, and nephews of their spouses. Okay. And in the final fourth degree of kinship and affiliation additionally includes a natural person's great grandparents, great grandchildren, great uncle, great aunts, grandniece, grandnephews, and first cousins, as well as great grandparents, great grandchildren, grand uncle, grand aunt, grandnieces, grandnephews, and first cousins of your spouse. So it's a very comprehensive definition of how they define kinship or affiliation when it comes to related parties. So if there is a transaction, let's understand it from our accounting point of view. If there is a transaction between related parties, an auditor would see it where it has that inherent risk of related party, and the transfer price may not be at par with the market price, so they would look at it from that point of view. Okay. Move to the next slide. Ownership. Again, another important topic. 2 or more juridical persons are related parties by way of ownership. If a juridical person alone or together with its related parties directly or indirectly owns a 50% or greater ownership interest in the other juridical person. Okay, so that's the kind of definition of ownership. So the rule of thumb or the benchmark here is 50%. Okay, and that's going to be our benchmark. We're going to go through an example. Okay, and we're going to see how it works actually. So if we can move to the next slide, please. Let's look at this. Computation of indirect holding. Company A holds 100% ownership interest in Company B. Okay. Company B holds 90% ownership interest in Company C, and Company C holds 80% ownership interest in Company D. Now, based on Article 35(1)(c)(1), Company B is a related party to Company A, which is pretty straightforward. Okay, this is because Company A directly owns more than 50% of the ownership. Okay, in Company B, so pretty straightforward. Now look at it from this angle. So in the above case, Company A indirectly has ownership interest in Company B as well. Okay. So initially, if you look at this, ownership, you might feel like Company A may not be related to Company D, but that's not the case because that's not how they look at it. Okay, The way they look at it is, let's crunch a few numbers here. So company D is 100% times 90% times 80% of company D, which takes us to 72%. There we go. And so it's, since this is over 50%, it's a related party. Company A is a related party to company D. Okay. Next slide, please. Thank you. Control. Once again, very subjective kind of area. Okay. And but we need to quantify it. All right, for our understanding purposes, not us, but the way it's being quantified by the tax authorities, in fact, as a person can also be considered related parties through direct or indirect control. Now, control is the direction and influence over one person by another person and can be determined in several ways, including but not limited to instances where a person can exercise 50% or more of the voting rights of another person. A person can determine the composition of 50% or more of the board of directors of another person, okay? Or a person can receive 50% or more of the profits of another person, okay? That's also control. And a person can determine or exercise significant influence or the conduct of a business and affairs of another person. Now, this is subjective, okay? Let's say if a person has control over the company or other person's decision-making, and that can make it, that can bring it under the same definition, right? Transfer pricing documentation, very, very important. I'm talking from the auditor's perspective. If we are involved in transfer pricing, where we determine our transfer pricing internally, and we have to bear in mind we could be subject to transfer pricing audits, okay? And when it comes to audit, we have to make sure we have sufficient and appropriate documentation, okay? Article 55 of the corporate governance, corporate tax law specifies the transfer pricing documentation obligations on a taxable person that enters into transactions with its related parties or connected person, okay? So the relevant UAE legislation has outlined 5 transfer pricing documentation required for certain taxable person that are required to be prepared for each tax period, okay? Now let's go through them one by one. Here is a summary of for your ease, okay? Transfer pricing disclosure form, which covers a detail of the controlled transactions during a tax period, okay? So transfer pricing TP disclosure form has to be there, okay? Master file, again, very important one when it comes to documentation, which provides a high-level overview of the group's business and the allocation of income and economic activity within a group. That has to be there, and it only applies to large businesses, by the way, as set out in the ministerial decision number 97 of 2023, okay? So that's master file, and then we have our local file, which provides detailed information on operations of the local entity and analysis and testing of the outcome of the control transaction against the arm's length principles, okay? So this is where you kind of compare and test the pricing that you have used with the market prices, okay? And you do the comparisons and make sure it makes sense and it's rational. Okay, country by country report, which provides jurisdictional quantitative information about an M&E group, and if that is above 3.15 billion, as well as an overview of the different activities conducted by affiliates of an M&E group as set out in Cabinet Resolution 44 of 2020, right? All right. Additional supporting information upon request of the FTA. Obviously, they have the authority, and if they feel like they need additional information, additional documentation, they can always ask us, and we are required to provide that to them. So if to recap the whole documentation thing, we need to have the disclosure form, we need to have the master file, we have to have the local file, and we have to have the country by country report. And in the end, we have to be ready if we are being asked for any additional documentation, we have to provide it to the tax authorities. Next page, please. Thank you. Okay, audit and risk assessment. Okay, so again, we have been talking about being getting audited, and let's talk about it in detail. So the burden of proof falls on the taxable person to maintain sufficient supporting documentation as well as to make timely submission to the FTA. Okay, so this is on us, on the entities. Okay, to make sure we have the right kind of proof to justify the internal transfer pricing that we have been using throughout the fiscal year. Okay. Okay, the FTA has the right to make queries and request information and data for its review and to arrive at a conclusion regarding the transfer pricing practices of the taxable person. Okay. Transfer pricing adjustments. Okay, so there could be a case or situation or circumstances where the tax authority may not agree with the transfer pricing that we have used. Okay, so what are they going to do? They will obviously ask us to adjust those transfer pricing to ensure they give the right kind of substance, and those are representative and they are at market value. Okay, so that's that. Okay, so just to elaborate on the adjustments, okay, it could be done by FTA, and it could also be done by taxable person. All right, so we can do it voluntarily if we feel like we haven't been using the right kind of internal transfer pricing. We can adjust it ourselves and disclose it to FTA in a timely manner. And at the same time, if FTA comes to a conclusion that we haven't used the right transfer pricing, they can ask us to adjust those pricing as explained earlier. Okay. And so one of the participants has asked if I can get the recorded video. Yes, you will be able to get the link through which you can get the recording of this video for sure. I'm just going to go through a quick question which is being asked by one of the participants, and the question is, what are the precautionary steps that we can take to comply with transfer pricing rules? Okay, so that's a very comprehensive kind of questions. And to answer that, so first thing first, okay, arm's length principle is very important. We have to make sure that we are complying with the arm's length principle. That's the premise of the entire transfer pricing. Okay, that's number one. Number two, documentation. That's very, very important, and we need to make sure we have comprehensive, detailed documentation, because let's say if we get audited, right, and if we don't have the right kind of documentation, we could be in trouble. We could be penalized. We can face adverse repercussions from the tax authorities, which is obviously a financial brunt as well as a reputational risk. Okay, so arm's length principle, comprehensive documentation is very important. And then thirdly, a continuous review of our internal transfer pricing. That's very, very important. You know why? Because the goal of transfer pricing, what's the goal? The goal is to make sure we are complying with the market price. Okay, and as we all know, the market price keeps changing. It's always on the move. It will keep changing. So if we don't monitor our internal transfer pricing, there could be a risk where we would be deviating from the market pricing. So we have to make sure that reviews are there. So let's recap it, okay? Audit documentation, arm's length principle, and continuous review. These are the three things which have to be there. And then also very important is to seek experts' advice. That's very, very important, because what happens is it's a new concept, right? Let's be honest. It's new for the entire country, for us as an accountants. So we need to make sure if we don't have the right expertise, in-house expertise, or if you feel like you don't have enough time to look into it the right way, seek expert advice. That's also very important. And this is where, our firm comes into play. If you feel like you have any questions or you feel like we could be of help, please do get in touch with us, and we would love to help you in terms of transfer pricing, right?
Hi, yes, Mr. Abbas. There is a question that came through. Are exempt entities also subject to transfer pricing rules?
Oh, thank you, Andrea. Good question. Yes, this is a very common question. And so exempt entities, they would feel like they are exempt from the transfer pricing rules and regulations. But honestly, that's not the case. So the FCCA expect all the entities who are involved or, they're kind of undertaking the related party transactions. They are supposed to be, they come under the same umbrella, and they have to take care of their market price. The only difference or the exemptions that they enjoy is they do not have to prepare the documentation, and they do not have to maintain the documentation. Okay.
Okay, the next question I have is, who should submit the transfer pricing disclosure form?
Okay, good question. All right, so any entity that would undertake transactions with related parties or connected person, they are supposed to submit these forms along with their tax returns, okay? And if they want to have further details, they can go to Article 55(1) of corporate tax law. That would help them to get in-depth understanding. Yeah.
Okay, the next question I have here is, what are the common issues with transfer pricing audits?
We could be subject to transfer pricing audit by the regulator, okay? And this could be very challenging and very time consuming. So what is the purpose of transfer pricing audit? Why do we get audited? The auditor wants to make sure that the internal pricing that we have used is at par with market price, okay? So that's the premise of the audit, all right? Now, how do we prove it to them? We have to make sure that we have detailed, comprehensive documentation. Okay, that's the key to have smooth audit. If we do not have sufficient and appropriate audit documentation, it's going to be very, very difficult to explain it to the auditor. So the crux is we need to have proper, comprehensive documentation.
Thank you, Abbas.
Thank you. Thank you very much.
All right. Thank you, Mr. Abbas, for educating us all in regards to transfer pricing today. And thank you to those who were able to join us, and of course, for your patience. For additional questions and concerns and on how to become a part of the Adam Global Provider Network, we encourage you to reach out to the number listed. Thank you, everyone.
Thank you very much. You guys have a good day. Take care. Bye-bye.